Okay, Professor Jim Schultz here from my Finance 513 students. I wanted to go ahead and record a YouTube lecture here on some of the material from Chapter 2. Obviously, I'm not going to go through the entire chapter, and so when I do these YouTube lectures, I'm basically going to pick and choose what I feel is the most important from that chapter, or what I feel might be the most difficult for you guys to have a good handle on working through those things independently. Or as I'm kind of looking forward to chapter 4 here, I think I'm gonna, sometimes I may add things that aren't even in the textbook that I think would really help your overall understanding and allow you guys to pull the most you possibly can, from this class. And so I've kind of got a skeleton here of some notes that are typed up for those of you that have had me before. You know that my handwriting is barely legible most of the time. And so I started to handwrite these notes, and then I was like, wait a second. I have all this technology at my fingertips. Let me go ahead and just put up a skeleton that's typed. Everybody can read it. And then, my expectation is that you'll listen to this lecture and kind of, jot down your own notes in your own handwriting that obviously you should be able to read. And so I can't really do that with the problems, the problem set, solution set I sent you guys the other day, because I like to work those out by hand. So, but anyway, I digress. So let's take a look here at the term structure of interest rates a little bit more closely. And so as you read through in the chapter, the term structure of interest rates can be explained by 3 different theories. Okay, these are not the only 3 theories that exist to explain the term structure of interest rates, but they're the 3 most common. So what I wanted to do in this lecture is kind of go through what each one of these theories means, and hopefully give you a better understanding of what you've already read about when you read through this section of the chapter. Alright, so let's start with the unbiased expectations theory. The basic idea behind the unbiased expectations theory is pretty simple. If investors believe that short-term interest rates are going to rise, then the yield curve is going to reflect that belief, and it will be upward sloping, as example 2.2 shows. So I'm right here right now on these bullet points. So if you look at example 2.2, you can see that if investors believe that short-term rates are going to rise, then that means the yield curve has to be upward sloping. That's because a 4-year bond has to give you the same return as 4 consecutive 1-year bonds, according to this theory. Otherwise, you would have an arbitrage situation. Therefore, since the yield curve, if you can kind of visualize, if you're looking at example 2.2 right now, right, you see that on the y-axis you have the yield, on the x-axis you have time. And so if the yield curve is upward sloping, what that means is longer term bonds are offering you a higher rate than shorter term bonds. That's the basic essence of the yield curve. Okay? With the unbiased expectations theory, if short-term rates are going to rise, then that means longer-term longer-term bonds must offer you a higher rate, because 1-year rates in the future are going to be higher than they are today, right? And so you see that exact example unfold in example 2.2. And if you've already worked through some of the homework problems, you actually have seen this phenomenon in some of the homework problems. Okay? So that's kind of the basic core essence of the unbiased expectations theory. That if investors believe short-term rates are going to rise, then the expectations theory corresponds to an upward sloping yield curve. Now, long-term investors will oftentimes look at the yield curve or use the unbiased expectations theory to basically decide, hey, is it a good climate right now to invest in some debt, right? Or should I wait because rates are going to rise and I could potentially put myself in a better position somewhat down the road, right? And so that actually gets into shifting of the yield curve up and down, which is not really something that I would expect you guys to be able to grasp at this point. But long-term investors will oftentimes use the unbiased expectations theory. Now, what about the liquidity premium theory? This one, in my opinion, is easier to understand. Let's scroll down a little bit. This one, in my opinion, is easier to understand than the unbiased expectations theory because of what you guys have already learned in classes like Finance 311 or Finance 680. Basically, this one's pretty simple. Longer-term bonds must offer compensation to investors just by the very nature that they are longer-term bonds, right? Ceteris paribus, if I could choose between a short-term bond and a long-term bond, if the ceteris paribus assumption is truly in effect, then I will always choose the shorter-term bond because shorter-term bonds are more liquid than longer-term bonds. I can more quickly turn those investments back into cash because they're going to mature more quickly. So, that being the case, you would always demand a higher return for a longer-term bond. Right? That's all the liquidity premium theory is suggesting. It's just suggesting that as investors choose longer term bonds, those bonds are less liquid, right? Because those bonds are less liquid, because investors are going to hold on to that money for a longer period of time, because a longer period of time by definition has more uncertainty associated with it, all of those things mean more risk. And as you guys already know, whenever you see more risk, there has to be a higher return that goes along with that, right? Otherwise, investors will never be interested in that product. All right, so that's the basic idea. Mathematically, the liquidity premium theory is actually identical to the unbiased expectations theory. The only difference is that when you're forecasting out into the future, you have to add liquidity premiums for each forecasted year or each expectation of a future return, which I think you saw this in one of your homework problems. And that liquidity premium is going to increase as you go out further in time because a 5-year bond is going to require a greater liquidity premium than a 2-year bond. And a 10-year bond is going to require a greater liquidity premium than a 5-year bond. So this is actually another reason why you should observe in normal circumstances the yield curve being upward sloping. Now the market segmentation theory, this one I think this one might be the most difficult one to understand. But the basic idea here is that the theory, right? These are all theories. So the theory here is that investors have very specific maturity preferences, whether they be individual investors or institutions like banks, hedge funds, insurance companies. They're going to have very specific needs and requirements and maturity preferences. So to motivate them to switch from their preferences requires that you attach a premium for that switch. Okay? Now, that line, that bullet point in and of itself is not super clear in my opinion. So, to take that one step further, these preferences, right, these desires that investors or financial institutions have are actually going to manifest themselves in the supply and demand of various dated securities. Okay? So, as the supply and the demand shifts or changes from short-term bonds to long-term bonds, that's going to alter the structure of the yield curve. So here's a great example of that. Suppose that the supply of short-term bonds was going down. Okay? If the supply of short-term bonds is going down, you guys know from economics that the price of short-term bonds is going to increase. And you might hear Teddy and Crouton in the background. I tried to cage them, but they might be playing in their cage. So I apologize for that. You may hear that all semester, but I'll do my best to keep them under wraps. But anyway, let's start that again. I got a little distracted. Let's say that the supply of short-term bonds is decreasing. If the supply of short-term bonds is decreasing, you know from economics that when the supply of something goes down, its price goes up. Okay? So if the price of short-term bonds is increasing, that means that the yields on short-term bonds are going to decrease because, as you learned in Finance 311 or 680, there's an inverse relationship between bond prices and interest rates or yields, right? Now, conversely, or actually, let's look at the other side of that. If the supply of short-term bonds is decreasing and the supply of long-term bonds is increasing, that means on the longer-term bonds, if their supply is increasing, their prices are going to fall. If their prices are falling, the yield on those longer-term bonds is going to increase. So that example that I just went through with the supply of short-term bonds going down and the supply of long-term bonds going up is going to lead to the yield curve becoming steeper or becoming positively sloped or more positively sloped depending on where you're starting from. Okay? And from that example, I want you guys to think through. I'm not going to go through it in this video. I want to motivate you guys and encourage you guys to think through this on your own. From what I just went through, and maybe you need to listen to that a couple times, you should be able to piece through mentally the opposite scenario. The opposite scenario where the supply of short-term bonds is increasing. What is that going to mean for the shape of the yield curve? That's the basic core essence behind the market segmentation theory. Now, the final thing I wanted to bring up that I don't know if this was really mentioned in the text. This is really important. So you've learned about all these theories and you have some idea about the yield curve now. Well, what does it all mean in practice? Well, here's one critical thing that is very important for your understanding of this whole section. The general slope of the yield curve, whether it be positive or negative, has a it's very telling as to what is probably going on in the economy at that time. If the yield curve is positively sloped, that is your quote-unquote normal circumstance. That is usually indicative of a healthy economy, a growing economy, an expanding economy, because it means that if you take more risk, if you go out further in time and invest in longer-term investments, you're going to be rewarded for doing that with a higher return. Right? And generally speaking, if everyone is more longer term focused, that's healthy for the economy, right? That means we're all kind of in this together and we're all kind of in this for a longer window of time. Now take the opposite scenario. If the yield curve is negatively sloped, what does that mean? That means that short-term rates must be greater than long-term rates, right? Think about it. Just visualize it in your mind. A negatively sloped yield curve must indicate short-term rates greater than long-term rates. That is not usually healthy for the economy. If you look back at 2007, 2008, you'll see a negatively sloped yield curve because what's happening is short-term investments are a better option. Nobody wants to go out on the yield curve and take all the risk of a longer-term investment because there's no reason to. They can get a higher return for a shorter-term instrument, right? So nobody would ever do that. And oftentimes when you observe that, you're in a scenario where the economy is shrinking, the economy is contracting, you could be in a recession, you could be in a depression. Generally speaking, negatively sloped yield curves they tend to correlate with poor economic times. Now, where's the yield curve right now? If you were to look it up, it's positively sloped. It is positively sloped right now in June of 2014. And, if you look back at the last, 18 to 24 months, I think many people would agree that the economy is healing. The economy is getting better. So I hope you guys found that useful, a little additional stuff about the term structure of interest rates, and hopefully a very nice supplement to your textbook reading. So I'll see you guys next time.